Hello and welcome to the stock specific class here for Thursday, February the 23rd. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. Also, if there's any audio issues that you notice, clicking or anything like that in the audio, make sure you let me know so I can dial back into the audio and see if that fixes the problem. All right, let's go ahead and get started. I was hoping that we'd have a little bit more clarity by the class today. I need to stop saying that. It's like sometimes I've been doing this a long time, and you have to know a little bit about my past. I grew up playing baseball, and baseball players, if you don't know, are very superstitious, and I've brought a lot of that into my stock market stuff. And one of those things is that it seems like anytime I make a definitive statement about something, the opposite is going to happen. And on Tuesday, I said we should. I was pretty confident that we'd have clarity on the direction of the market by Thursday. And what do we get? We still are in kind of that questionable area here. So we'll take a look at that here in a second. I'll show you what I'm talking about. But as far as the direction alerts, we haven't seen much of a change here in the last couple of weeks. We've just kind of been in the middle, and really, when you look at it, the market has just kind of been in this range. It's gone up and it's gone down, but it's kind of overall been in a little bit of just a sideways range for a while, and now that is the market telling us that it's indecisive and it doesn't quite know where it wants to go next. And but it's also important to recognize that when the market is moving a little bit sideways like that it's preparing for a move. It's preparing to take off in a direction. If you were to ask me which direction I would lean towards right now, I'd probably lean a little bit more towards to the downside. But again, I'm going to see wherever it wants to go. I'll go in that direction. I'll trade in that direction. But as far as the direction alerts, we're just not in any extreme level, overbought or oversold, and that's what these are telling us. So we don't want to spend a lot of time on these until they're actually signaling something that's significant, or at least approaching something that's significant that we need to be aware of. The sentiment indicator is still stuck in that high complacency range, again, that's bugged me for quite a while that it's remained that elevated, but the market has managed to still kind of ignore it. At some point it won't, but that's why you don't trade on that alone. And the VIX or sentiment in general, it's such a, you want to be aware of it. You want to be aware of the market sentiment. Is the market fearful? Is the market confident? Is it overconfident? But you don't want to ever base your trade off of that, because you'll be wrong, and you'll be wrong for a long period of time if you are basing your entire trade on market sentiment. Buy-sell ratios, I told you on Tuesday we'd probably see the sells outpace the buys with the recent pullback in the market. We're seeing that, but we're not at any extreme level yet as far as that's concerned. And so, no reason to spend more time on that sentiment. And we're right smack in the middle now on this sentiment indicator. Gets down here, it'd be oversold. You'd expect the market to rally. When it gets down to this level, if it gets up to this level, you expect the market to pull back. Again, you don't want to base your entire trade on that. But if you're getting ready to get into 5 stocks long, and the sentiment indicator is right at this overbought range, there's a good chance that you're going to get stopped out of probably half of those, or maybe all of them, within a little while. Or more importantly, that you would probably be able to pick those same stocks up at a cheaper price if you're just a little bit more patient and wait to see if the market pulls back a little bit and gives you a little bit better entry point. If you don't care about a better entry point, then obviously that doesn't matter. But you'd want to be aware of of the fact that the market is in that overbought condition. And this is a great indicator. It doesn't hit that extreme level very often, but when it does, you go match this up to what the market ends up doing, and it is pretty accurate. Again, not to the exact day, but within, usually within about a week or so, you're going to see a pretty significant market reaction to those overbought or oversold extremes. And so you definitely want to check those out. Now, a lot of times you'll get to a point where you can sense the market is getting overbought. We had that big run up in January, and we had kind of the short squeeze in the market where stocks were moving up very quickly. We were seeing consecutive up days in a row, and you start to sense after a while, after a few days of that, you start to sense, man, this is moving up pretty fast. And sure enough, we did hit that overbought area on the sentiment indicator. So I'm not saying you have to check this every day, but you'll get to a point where you'll start to sense when the market is getting a little extreme, especially, like I said, if it's gone up several days in a row or down several days or a really big down day. That's the thing. It can hit this oversold area pretty quick. Sometimes you'll get two massive down days or something, and this thing will drop down there very quickly. You saw that this was back in December. We had that 2 or 3 days where we dropped really, really sharply, and it got right down there very quick. So, but this is very helpful, especially for the shorter term. And by shorter term, I'm talking trades you're in for a few days or a few weeks. Just be aware of it, because again, you can find a perfect pattern, a stock that you just love, but if you're at one of these extreme levels, you definitely need to factor that into your decision as to whether or not you want to go forward with that trade, because it can be an extra obstacle for you if you're trying to go against these extremes. And so, this is just another area where the software can be very helpful for you. All right, let's get into the chart here. And so back on Tuesday, we had this big down day right here. And yesterday, now I did say on Tuesday, I did say that we always have to allow for a pause day when we're expecting a move, because sometimes the market will just take a day off and evaluate what's going on. You see it happen all the time within moves. But then what happened today? So today we were supposed to at least get a little bit more clarity today. But what happened is we opened higher, so it looked like that was a bullish open. It's opening higher there. We had the positive NVIDIA news that looked like it might maybe cause the market to rally a little bit, and then we've come all the way back down. We're trading lower than where we closed yesterday. So we're back to indecisive again. We could be going either way. Now, I think it's important to understand well, it depends on how we close, but it's important to understand this price action right here, because you can immediately think, well, that's really bearish if we tried to rally early and then we're dropping, we're going to close down again. Well, not necessarily. There's a couple things that we'd want to watch for today. Number one, do we close at the lows of the day, or do we build on the downward move? Now we're off the lows right now, which is actually a little bit more of a bullish sign if we were to close like that. Now volume is going to be important. If I would assume that volume is pretty light, fairly light today, it could end up about up to these averages up here. Sometimes it's hard to tell, because that's obviously not, this is going to keep going up. There's still more volume to come in today. If the volume were to stop, market were to close, it would be light volume, but it's going to move up a little bit higher. I know we only have a couple hours left, but a lot of the volume is in that last hour. So you have to account for that. Now, back here in December, you can see with some of these drops right here, you got huge volume. So what this is showing me so far is a little bit of selling exhaustion. Now, again, that could change, but you had a down day on Tuesday, a pretty decent down day. You know, we kind of broke the trend line. It's not a real straight line there, but kind of broke a trend line. Then we had this indecision day today or yesterday. And then today we tried to open lower. We're moving downward, but we're not seeing acceleration. We're not seeing, you know, the heavy selling taking place right there. And so it's still a reflection. If you're thinking of a tug of war between buyers and sellers, there's still no one winning that tug of war. But you got to ask yourself after this drop right here is you know, why aren't we seeing an acceleration to the downside? Now that can maybe it's the market waiting for a trigger. You know, is there a news event that comes out that it's just waiting for a reason to sell? You know, when people think of news or say the market moves on news, it does move on news, but more important than the news. And I haven't talked about this for a while, but those of you that have been around for a while, you know, I bring this up from time to time. It's not, the market doesn't react to the news. The market reacts to the news based on its mood. What is the market mood? And that's part of what we're doing when we go through and do this market update type analysis, where we look at different things in the market. We're trying to see the direction. Is there a clear direction? But we're also trying to gauge the market mood. Is the market feeling really bullish? Is the market feeling really bearish? You know, the best way I can explain this is in real life is you know, how do you react to the same news? Now, let's just take something that would be very negative. Let's say that let's take losing a job. Okay, that's a very traumatic experience, but you know, it's not maybe as devastating as losing a loved one or something like that. But let's just take losing a job, for instance. Let's say that you woke up that day and you're going to work or you woke up late. You're trying to scramble to get to work. Your tire you get a flat tire. You have to change the tire. You know, you go to buy gas and your card gets declined or something like that, and all these things just feel like the world's against you. And then you get into work and your boss tells you you're fired or you're getting laid off. Well, that news is even more devastating because of the mood that you're already in. You're already in this negative mood, this down mood, and then you get this bad news that really is devastating to you. Now, think of the opposite, where, you know, I don't know, I can't try to think on the top of my head, but some positive news. Maybe you stopped off at the gas station, you won the lottery. You know, you have $50,000 you just won on a lottery ticket or something like that, and you had a bunch of people that smiled and said hello to you, so you're feeling really good about yourself, and you walk into work and you get laid off. Well, that's the same negative news, but your reaction is going to be different. It's not going to be as devastating to you as it would if you were in that other type of condition. Now, again, I'm just trying to give you a quick example of what I'm talking about, but the market is kind of does the same thing. It's in a bullish mood. It will ignore bad information, negative information. When it's in a bad mood or a negative or fearful mood is maybe a better way to put it, then any sort of trigger or negative information will cause those big sell-offs. And that's what we tend to focus on, is the news that comes out that triggers the sell-off. A lot of times we fail to recognize some of the symptoms that were leading up to that news item. And a lot of times those can tell you, if you can recognize the market is in a very bearish condition, then you know, it could be positive news that the market ends up selling off on, you know. And in the case right now where positive news is bad, you know, because the Fed, they caused the Fed to tighten for longer or something like that. Um, but but the key is to remember that traders, and it's human nature, traders are always looking for reasons to buy or reasons to sell. You think of this big fund manager at his desk. If he starts unloading stocks and selling stocks just because his his uh, his algorithm or his formula or what have you says to sell, and his boss comes up to him and says, "Why are you selling?" Oh, because my algorithm said to sell, and the market or the stock starts rallying or something like that. That guy's going to get fired pretty quickly. It may not be a strong enough reason to sell. Maybe that's not a good example because some of these algorithms are actually really good and people have a lot of confidence in. But the point is that every trader needs to usually, at least these professional traders, need to be able to back up the reasons why they're buying or selling. And that's why you see hours and hours on CNBC of people's opinions of why markets are going to go up or go down or what have you, is we all need these reasons to do what we're doing. Now, our approach is a little bit different in that we're not going to worry too much about the news as we are the chart. But it's the same thing. Why am I buying? Well, if the market started to move up right here and he said, "Why are you buying?" I'd say, well, because we're reaching higher highs and higher lows. This could be a completion of a bullish ABC pattern. And and we're getting confirmation with it moving back up right here. Well, there are my reasons for doing what I'm doing. Okay. But it's important what you don't want to do as a technical trader is to try to mix those two, mix your market fundamentals and market technicals too much. Okay, I'm not saying you can't look at both, and I do talk about both. You hear me talk about macro stuff all the time, and Fed meetings coming up, mostly because I know that those can be triggers. Those could be reasons why the charts will start to move in a certain direction. But from a technical approach, you want to make sure that from either approach, you want to make sure that you know what your focus is. The problem you can run into is if you try to mix fundamentals and technicals, or at least not know which one is your primary reason for trading, then you can use the other to justify, so you can have a market that's breaking down and breaking, support levels and you have a bias of being bullish. So what do? The technicals are saying the market's going down, but you don't want to believe it. And so what do? You go look at a fundamental reason why the market's going. Well, the valuations are still pretty cheap right here. And that's a reason why this is just a short-term sell out the markets are going to go back up. You see, the problem there is that you're flip-flopping to get to the whatever conclusion backs up your bias, and that's only going to lead to really bad results. So always, and I'm assuming I'm assuming anyone using the software is going to be more technical oriented, and look at what the chart is doing, what the price action is actually doing. All right, so we're seeing a little bit of selling exhaustion. Now, how does that tie into what I just talked about over the last 10 minutes or so? Well, again, that can change. Obviously, it's indecisive what's going on. So indecision can mean you can go either way. But it's getting a little bit more of a feel just because it's paused now for a second or kind of been indecisive for a second day in a row. It has that feel of looking for a reason to buy. Sellers just aren't. Well, sellers could be looking for a reason to sell, but they're not selling aggressively just yet. And so we're still back to kind of what we're at on Tuesday. We're still in an area where this could still be wave C, because wave C is a little bit longer than wave A right here, but still it's about the same length as wave A. There's a little bit of support in this area over here. We're not too far away from that. If you want a number, the 400 level on the SPY, you can see we're a little bit below it right now. 4,000 level if you're looking at the SPX, but that is a key area that everyone seems to be kind of focused on. I think it now obviously we've been trading below it. It hasn't triggered any big selling. Could it? And it could be, like I said, if it can get up above it, that could be more of a support for it. But this is what the trading crowd is kind of focused on. So it might take a break of that, a decent break of that to trigger the bigger selling. By the way, when we're looking at these charts, it's really important to keep in mind that we're not the only ones seeing this. I'd love to be able to come out here every week and say, I'm the only one that's seeing this, and I'm going to present it to you. And you're going to be insiders. Nobody else can see what I see. But the reality is that anyone that knows how to read a chart and has been doing this for a few years is seeing the same stuff. So now that's not to say that there aren't areas that people don't always see. I think price action, people don't always read price action very well, although candles are becoming more popular. People using candlestick analysis has become a lot more popular over the years. But there are subtle things like I said, recognizing buying exhaustion, selling exhaustion. I do think it's important to point out, because we had this happen with buying exhaustion. We had buying exhaustion right up and through here. It doesn't always lead to a reversal. Selling exhaustion doesn't always lead to buying. A reversal into buying. Buying exhaustion doesn't always lead into selling, or it doesn't necessarily mean it's got to last for a long period of time. If this was buying exhaustion, you got this little drop right here, and now you're getting selling exhaustion. Maybe you just get a rally back up to here, and then maybe you're getting buying exhaustion again. Maybe you're going to be just stuck in a range for a while. It's not necessarily catapulting the market into a big move, but it's important to recognize that price action, because it's one of a ton of things that we're going to be looking at or analyzing. It's part of the puzzle piece of the puzzle that we're putting together to determine what to do next. Now, bottom line is that we're kind of still stuck on Tuesday because we don't have any confirmation either way, and because of that, I am going to go over a lot of stocks today, but it's going to be really critically important that you wait for confirmation, because we don't want to be loading up on every stock that I go over today, and then we do get the big sell off. It does kind of trigger the bigger sell off there. So now there are other indexes we could look at to see, and this is why we look at other indexes, is are there clues on some of the other indexes that might indicate a stronger direction. We do have the Dow right here that broke. It had this little wedge formation that we were looking at for the last couple of weeks, and it broke below it. I think it's also important to kind of point out here on the Dow is we're on the left side of the extreme reversal risk range, so we've gone down a little bit too far too fast. That could lead to a little bit of a bounce, or could make it harder for a big drop to take place from that condition. Not saying it can't happen, but usually when you have your bigger sell-offs, you're usually selling off from, you might be in this kind of sell hold range right here. Now, once you do start to go, and it does go right to that extreme range, it could stay there. It can go even lower when you're at the extreme, but usually it starts. You usually start in this area here. You start to have that big sell-off. We kind of saw it back here where we were actually up in the buy range back here in December, and then we dropped on this first move down, dropped very sharply, and that put us. I think it put us in the extreme range, but not quite to the far right side. I can't remember how far it went, but it could, if we would have had another move down, it could have stayed at the far left side extreme. It could have stayed in that extreme range for a little while. So we're up. We're not down very far after hitting that, and we weren't really sharply dropping right here. And so again, that would lead me to believe that we're in a position where it could be a little bit more likely to bounce or move sideways. Remember, a sideways move can kind of alleviate that extreme condition as well. Let me check where the S&P chart was. Yeah, so S&P isn't in that extreme range, but you see the S&P is in a spot where it could have a big drop from here and get pushed all the way to that right side or left side of the range there. NASDAQ, same thing. We're kind of in that hold range there. And seem like we're kind of holding this little support zone. Right in here, it used to be resistance. And a little bit of support right there. It might be support here. We're trading off the lows of the day here on the NASDAQ too, back to being positive. But it's still, again, it's still kind of showing that the fact that we opened higher and we went lower and now we're just kind of back. It's still showing that indecision. And then the Russell. Now the Russell did break below on Tuesday. It did break below that support resistance level. Kind of back. Now see where we're at right now. We came off the lows today, but we're sitting right at that trend line right there. So if this is how we close, again, it just pushes everything to the next day. You got to wait until we see the definitive move out of it, up or down. Now, could it be that this is just a little retracement of this drop right here? We retraced about 50% of that drop. Well, like I said, we have to wait. We have to see which way it goes. It could go, like I said, it could go either way. Bonds, Tuesday they were down near these lows. We've rallied a little bit off of that. It's hard to tell whether this is just a correction of this move down and that we're going to break below it. The fact that we moved beyond that 618 retracement level, which was right in here, would indicate that it's more likely that we go to a lower low, break lower. This is probably just a correction for a move down, but it's still a little bit too early to tell on that. But if you see a bearish reversal candle, you see it open higher then close lower, that's probably signaling the start of another move down. Well, again, we got a lot of indecisive moves here. Gold, I might have to see how my gold trades are. We were right at the stops at the beginning of class, or below the stops. I usually like to wait to the end of the day to see if it's a close below it. I'll look at it. I may just go ahead and stop out if we're decent amount below it, just to show some people how to do that, how to go ahead and exit the trade there, do it in class. But I usually like to see a close. But gold has been, we're still trying to figure out, is this an ABC or is this, wave 1, 2, 3, 4? Maybe we're in wave 5 or something like that, and then maybe that's just wave A, and then you get wave B, wave C. Maybe we're in a larger correction. Or like I said, could this be ABC and it just starts taking off? A lot of it will depend on how the rally looks when it starts to rally. Does it really take off in a impulsive manner, or is it more choppy as it tries to rally, corrective looking as it tries to rally? Oil dropped pretty big yesterday, but remember there's that support area down here. Now, this is what I warned you about, though. This is where you have to be a little bit careful. I said this is that area of support is where the U.S. government is targeting a price they're targeting to start replenishing the strategic oil reserve. They've been pumping oil out of that to try to keep oil prices down. They need to replenish it. It could be a little bit of a backstop for oil at that level, because obviously you've got one of the biggest buyers on the planet that would be stepping in and buying right there. But obviously that seems like, it seems like a trade that there's no way it could lose. I don't know how that process works, so if anyone wanted to go study it and find out exactly if they actually do buy at that level, let me give you an example. Like the companies at their earnings reports sometimes will announce buybacks, stock buybacks. We're going to be buying back our stock, and we're going to spend this amount of money buying back our stock, and then they don't end up. Something happens and they don't end up buying back the stock. They made the announcement, but they didn't actually do it. I don't know if that's similar to where, the U.S. government makes a statement that, hey, we're going to be buying back at this level. They change their mind, and because think about it, it could be, the oil gets down to that level there. The gas prices start going down. Is it, the politics of all this? I'm thinking in terms of human nature, right? If I'm the president and I see oil prices coming down, that's going to be good for my approval ratings, because that's something people see every day, or every time they fill up their tank. They make the mental checklist of good or bad. Oh yes, it's a lot lower than it was last week. Where there'd be temptation to say, well, let's see if we can go a little lower there before we start buying. Let's not be so anxious to jump in there and push oil prices back up again. So I don't know. I don't know if that plays into this or whatever. So the point I'm trying to make is, don't just go buy oil just because it's down this level thinking it's guaranteed to go up at that point. We still want to pay attention to what is actually going on. I could see oil dropping below this level because so many people are looking at it as they're probably buying right here, and they're probably putting their stops down here. And if it breaks below that level, guess what's getting triggered? All of those stop loss orders, and you can see a whoosh down in oil if that were to take place. So I'm just saying, although we talked about this, and we'll continue to look at this area right here, and you'll hear me bring up, government level there that that they plan to step in. Don't assume that means that it's a guaranteed trade. There's a saying in Wall Street that it has to do, well, it kind of fits this scenario here. It's when it feels safe to get in, it usually isn't. And it's great to apply this to any stock as well, especially if you spend hours watching TV and somebody comes on TV and they make a great argument about a stock or what have you. If it feels like, because nobody wants to lose money, and so what you do is you want to wait until you feel confident in what you're doing. And some people, they're really risk averse. They lose $1 and they freak out. Those people probably shouldn't be trading in the markets, because losing is such a big part of winning, is such a big part of trading. But they wait until everybody agrees that they should be in the stock. Everyone likes their decision to get in the stock. The stock is up, so the stock has been moving up and up and up and up and up, and it gets up to this point where it's going straight up. Everybody loves it. Everybody's recommending it. You decide you want to get into it, and everyone says that's the right decision. You come join us, and it feels like you're guaranteed to win right here, and then you get in, and then bam, it just drops. If you're waiting to where it feels safe to get in and get to the point where it feels safe to get in, it usually isn't. Now, in this case, it could be the opposite, where you think that there's, you know, there's that magic buyer that's going to keep you from for losing money on your oil trade. You're guaranteed to make money because of it. It feels safe to get in. Well, the market will find a way to make sure it isn't for you. It just does that. And I don't know why. I can't explain it. It's not a mathematical formula. There's another Wall Street phrase that says the market tends to hurt the most people as possible. How does that happen? Well, it only happens when the trading crowd gets too far to one side. I've mentioned this before. We see it in sports. I mean, look at the Super Bowl. How many people? All the people that were picking the winner of the Super Bowl. Almost everyone on at least the TV broadcast were picking the Eagles. And whenever I see that, it's just natural for me to say, uh-oh, there's too much sentiment to that one side, and particularly when teams are pretty evenly matched, a lot of times you're going to see the opposite happen. The other team will end up winning. And again, I can't explain it. There's not a mathematical formula for it, but I see it play out in the markets all the time as well. That you have to just kind of, it's just one of those things that it becomes part of your intuition when you start to see that. And again, it's not something you're going to trade by itself, but you see a market drop and you see a bullish reversal candle, and you sense that the crowd is too bearish on a stock or on the market in general. And that's when you're like, oh, this is where it's going to rally. This is where it's more likely to rally right here. The dollar's been moving up, and this is what's been causing a lot of the drop too. The market's been going the opposite of the dollar, although it's off the highs. And if it drops lower than where it opened, that would actually be what we call bearish shooting star candlestick formation. That could be a reason why the market could rally, is if the dollar pulls back a little bit over the next couple of days. So that's something to keep an eye on as well. There was a comment here that the S&P has moved back above 400. Let's take a look at the SPY chart real quick. Yeah, so it's gone positive. It's not showing up here above 400, but remember, this is the price is delayed. It's delayed like I don't know what the time limit amount is on it. It's not real time prices, because we don't need real time prices for the type of trading you use the software for, which is a little bit longer term, several weeks to several months that you're looking to be in trades. But I'm sure I can see on the TV that it has moved up above that 400 level. So we'll see if it holds that. Again, even if it just barely holds it into the close, and even if it comes all the way back up, and goes positive, you say, well, that's a hammer formation. Well, yes, but the hammer it works a little bit better when it's below everything. So if it were to gap down, drop down, and then come all the way back up and close higher, that's where you have a powerful bullish reversal hammer. If it shows up above the lowest point, it's not as effective. Although there was a bullish hammer right there that took place on Friday, and it didn't rally off of that. So it's not that, those aren't guaranteed to work every time either. All right, I'm going to skip the other market update stuff because the bottom line is we have a little bit of an indecisive day. I want to get to the purpose of the class, which is potential trades. I'm going to start off. Well, the bottom line though is that, again, to recognize we're in that indecisive condition. So we definitely would want confirmation on these patterns that we're looking at. A lot of times that can be a breakout, a strong bullish bar going from a hold signal to a buy signal. And although I'm going to go through several, it does not mean get into all of these or consider getting into all of these. I think that's important. Again, I mentioned this on Tuesday, or I might have mentioned it last Thursday. The part of the problem with doing these classes, I know I get someone new. They just signed up. They're excited. They're waiting for the quote unquote expert to tell them what stock is guaranteed to go up. And then they start jumping into everything that comes out of my mouth. And number one, over position. There aren't too many positions. But number two, they decide not to wait for confirmation, or they ignore when I say wait for confirmation, or they ignore the analysis ahead of time that the market conditions are indecisive. It could go either way. It could have a big down move soon. Wait a couple extra days to see if the direction gets confirmed. They ignore all that other stuff and they just focus on the ticker symbol. So just don't be that guy or that lady. Don't be that person. Make sure that you listen to everything that I'm saying in the context of the whole class. But I do understand that, you might want to put some money to work here, and you're looking for an idea. That's the case, and then take a look at some of these that I go over and decide maybe on one or at the most maybe two that you would want to put to work. All right, so let's start in the new buy list. And I like the one right at the top here, the IQ. This IQ. Now it's down today, but I like a couple things about it. Number one, you probably notice it's moving sideways right here, and the previous move was up. That's something I talk about all the time. Whenever you see a stock moving sideways, pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. By the way, this also gives us a good range to tell us how far it could go after it breaks out. If it breaks out above that range, it will typically, not always, but many times it will go the same distance of the top of the range to the bottom of the range. And so it can give you an expectation of where it should go, and that gives you confidence to kind of stay in a trade, not get shaken out of up and down, or on down days. You get a down days or a pause day, there's a tendency to freak out and I better get out. And what keeps you in the trade is knowing about where you expect the stock to go, and having the confidence that it'll get there. Another thing I like is that when it broke out, it pulled back to the breakout area. So it's kind of consolidated on that breakout area. Here's the previous high right here. It pulled back off of that. Look at that nice little ABC pattern right there. Broke out. And then what did it do? It came back and retested the breakout. Now, that's also important. It could be important for placing stops. You get a stop loss down below here. Not right below it, but a little bit below it. If it were to break that range, you might want to get stopped out. Although the reason why I say you might want to have a stop down a little bit lower is that I've talked about this before. It's been my experience over the years that when you see a real distinct sideways pattern, what that is showing, and it's lasted for a little while, that is showing indecision. We know that. But sometimes that indecision starts to last a little bit too long, and you don't like to see it move sideways for very long. This is really getting to a spot where it needs to break out, needs to do something. It's getting a little long, and sometimes what will happen is it'll come down, and it just needs a spark. It gets down to this level here, and the buyers just aren't excited about buying. They buy, but then they quickly fade when it gets up to the upper part of that range. They don't want to buy up above here for some reason. And again, I don't know what the reason is. You don't need to know what the reason is. It's just that's the behavior. Well, sometimes what will happen is you need something to jumpstart the buying. And so in other words, when it gets down here, the stock is on sale, but it's that sale, you're at the store and you see something you buy all the time. You see it's on sale, but it's like, that's only like 5 cents cheaper than full price. Yeah, it's on sale, but I'm not going to buy 6 of them. Maybe I'll buy 2 instead of 1 because it's 5 cents cheaper. No, you want the BOGO, right? The 2 for 1. You get the BOGO price, and it's like, all right, I'm cleaning out the whole shelf. I want all of it. Well, that's kind of the same idea here. Is it needs something to jumpstart the stock. So what happens is that it dips down a little bit, and then the traders say, "There's the BOGO," and then it rockets higher off of that. I see this happen all the time off of some of these sideways moves, and so you don't want to have your stop right here to where it goes stop out. It goes a little bit lower than BOGO. It takes off. So you want to have it down a little bit. How far down? There's not a real clear. I can't give you a mathematical. It's more of a sight thing here. I might have it a little bit more at this midway point of this run up right here, down there a little ways to where it could break through there a little bit, and then maybe that's what caused it to take off, or wait for it to break out above here. And that'd be probably more likely in this case because you're down 2 days in a row. You look like you're working your way down to this low down here. Why jump in and buy it right now? And this probably went back to a hold signal. Yeah, it went back to a hold signal today. But why not just wait to see if it breaks out and buy the breakout? So put this one on the watch list and probably look to see if it breaks it. Now, if it breaks out, I would put my stop right up below there, or consider that as a stop loss point. Because it's unlikely to come back into that range. And if it comes back in that range and all the way back down and stops you out, it probably is reversing. Remember, when I say this stock moving sideways, previous move was up, it tends to, it'll have a tendency to move in that same direction after it's done moving sideways. It doesn't mean it's going to necessarily make a big move up out of that. Sometimes I see stocks break out. So that did work. It did break out of that sideways range. It did go higher out of that sideways range and then immediately start coming back down. That's a false breakout. Those happen. And if it comes all the way back down to the bottom of the range, you're probably in a trend reversal. It's probably in a much bigger correction. You probably want to be stopped out at that time. All right, another one. Oh, I wanted to show you an example. I remember last week, or one of these updates, I talked about a buyout, what a buyout looks like. This is what a buyout looks like. So this stock, MYOV, gapped up to here. And what probably happened here, I don't know for sure, but just the way it looks with this big gap up and this consolidation right here, is there was probably an initial buyout offer. It probably somewhere in this range right here. And then somebody else came in and upped the offer and offered a higher price for it. You don't see this very often, but sometimes it'll happen. I don't know if that's what happened here. I'm just assuming because of the big gap, the consolidation, and then another gap. And this is a flat line where it's not, see how it's not going anywhere? Whatever that price is, it's probably $27 or something like that this thing got bought out for. And it's not going to go anywhere. So if you're like, boy, this stock just gapped up, I'm going to buy it. Well, good news is you're not going to lose any money. Bad news is you're not going to make any money. You're going to sit there until that buyout is complete. And so now we try to get that out of the software as best we can, but we can't eliminate it completely. But so that's why I'm teaching you to recognize it. And the easiest way to recognize it is, well, first of all, if you see a gap up and you're going to buy the stock, go find out why it gapped up first. Did it gap up because it had a great earnings report? Okay, then, I still like to buy gaps like that big because a lot of times the higher probability on a gap is that it'll either pull back, it'll fill the gap, pull back and fill the gap, or move sideways. So what happened here? If you bought that gap and moved sideways for almost a month, 3 weeks or whatever, very rarely does it gap up that big and keep going right immediately. And so I don't usually like to buy big gaps, but if you are, find out why. Because if it's a buyout, it means it's probably not going to go any higher than that buyout price, and it's there's no reason to buy it at that point. But that's what it looks like. I'll show you another one I found too here in just a second. All right, another one. Oh, muscle stocks here. TITN, Titan Machinery, 95 strength rank. Again, you've got this nice defined uptrend. Again, could you wait for it to break out? I would definitely wait for it to break out, because what you also have right here is a little bit of a wedge formation. If it breaks that support level of the wedge, this thing's probably got a big drop coming. Again, that's why I'm a little bit bearish on the Dow chart, is because it broke the bottom of that wedge. Now, again, not every chart pattern will work perfectly. I'm not saying that the Dow has to drop significantly from breaking that support of the wedge. But a majority of the time, that's why we focus on those types of patterns, is it does increase the probability of a certain move when you get that. Now, the opposite would be true. If it can break out above that range, that would be a lot more bullish. It could start to take off. So I definitely would wait for the breakout there, see if it can break out. All right, let's do one more on the new buy list. HBT. Again, it's just a nice uptrend. It did recently break to a new high, and it's kind of paused right here on that breakout. So, I mean, of many of the charts I'm showing you, that would be one that if you did, want something right now, that is breaking out. It did break out. Now, what does that mean? If it holds that breakout, it could go up about the same distance as the top of the range to the bottom of the range here. And again, not that it goes up to that distance and it's done, but that's kind of a minimum expectation that it'll at least go that far. Also connect your trend lines right here, and it did reach an intraday high at the upper part of that range. But I mean, you can manage this pretty easily, where because it's broken out, you could probably get a stop right below here. That's the other thing I like, is look at broke out, retested the breakout right here. That'd probably be a good place for a stop. Wouldn't be very much risk. And by the way, that's all we can control, right? Is we can look at the chart, decide what our risk is going to be, where we're going to put our stop. People ask me all the time, well, where do you put stops? And my simplest reply is, you always want to put a stop loss where you know that you're wrong, not Jerry. If you say, well, Jerry, I don't see why I would be wrong if it got below this area right here. Okay, then you have to pick a different stop, because that's where I would stop, because that's where I know I was wrong. It broke out. It came all the way back down and came below that sideways range and below the previous high right here. This is where I know I'm probably wrong. Yeah, it doesn't mean you are wrong. Could it come down, stop you out, and go right back up? Yes, we're just talking about probabilities. It's very unlikely if it comes all the way down and stops me out, because it probably means the market's selling out too at that point. And so I don't have that momentum in my favor at that point. But that's all I can control. I can say, okay, here's where I know I'm wrong. Here's where I'm buying because it's breaking out. That's in my favor. That's going to go higher. Here's where I know I'm wrong. Here's what I'm willing to risk. Let's say it's $500 or whatever. And then maybe you take it a step further, and you say, okay, if it moves up that same distance, or maybe there's a previous resistance area back here that's up here away, and it probably needs to be up a little bit further than that, to where, okay, if I'm right, I'm going to make $1,000. If I'm wrong, I'm going to lose $500. That's a nice reward to risk. I have a chance to make more money if I'm right than I lose if I'm wrong. I've done all I can control as far as the probabilities, analyzing the probabilities of that thing going higher, going up. And then it just becomes, it becomes just a numbers game after that. You get into enough trades where the probabilities are in your favor. Not all of them are going to work out. But you know that, and you don't know which ones are going to work out, but you know that you're going to get enough of them that work out that are going to make you more money than what you're losing when you're wrong. And that's why it's also important in these classes that you don't just grab onto one stock and that I talk about and say that's the golden ticket. I mean, yeah, it might be, but you're trying to it's not always going to be, and I don't know which ones. I get this a lot from newer traders that are like, well, just tell me which ones you really like the most. I can tell you which ones I really like the most, but still it doesn't mean that they're going to work. And believe me, if I knew which ones were always going to work, I would never mention anything. Why would you ever mention a stock that isn't going to work? There'd be no reason to. And the fact is, you can't know, and that's the wrong approach. If you're looking for the perfect stock that doesn't exist, you want to switch your mentality to just play the numbers game. I guess I learned it early without knowing it. I learned it playing baseball. I don't know which pitch I'm going to hit the home run off of. I just know that if I get enough of those pitches and I put good swings on those pitches, then I'm going to end up with 20, 25 home runs at the end of the year. I don't know which game or which situation I'm going to hit it. I don't know that. I just know that if I focus on the process, the results should be the same every year. And that's what I'm trying to get you to focus on with all this stuff. All right. I need a quick yap and then start showing you stocks. So let's go to let's start off in industrial products. There are so many good patterns in industrial products. Under the hold section right here, this OI glass, 97 strength rank. Again, what I like about it, you have this move up, ABC pattern, move up. This looks like it's A, B, C. Could still be in the C leg though, so it still could come down a little bit. Could come down to the breakout area. But I like the pattern that's developing there. You definitely want to put this one on the watch list because if it does start to move up, that could be a good one. I really like this PO. Let's go to, where is it? POWL right here. Powell Industries. Is that what it is? And Powell. I don't know. POWL. Same thing. Nice uptrend it's been in. Again, there's your breakout area, kind of an ABC, up a little bit today. Could it still come down into this area here? Could you wait for it to go back to a buy signal as confirmation? Sure. I mean, that wouldn't be a bad confirmation at this point. How close is it to going to a buy signal? By the way, if you want to know how close it is, you can look up here on the slide bar. It's still a little ways away. So if it's right here, then any other move up is going to push it into that buy range. Right here, it probably need to come up to about right here or so, trigger a buy. But that'd be good confirmation. I mean, I also liked AIT. Again, you're going to see almost the same patterns on all this. Big move up, A, B, C. Again, I don't know if wave C is done yet. Here's the breakout area. Can it come down a little bit further? Yeah, it could always come down a little bit further, but that's. And this is a good example of impulsive corrective. This is impulsive. It went straight up right here. And then notice how as it's pulling back, it's not pulling back like this. It's pulling back in a choppy side, a little bit. It's not obviously not completely sideways, but it's kind of sluggish on the pullback right there. It's not dropping dramatically. What that tells you is that the drop is caused by profit taking. People are just taking profits off the table. They're not hitting the sell button heavily and just get out, get out, get out. They're trimming, they're just, and that's a good bullish, that's the type of selling that you want to eventually buy into, is just that, profit taking, because that's how the institutional traders trade. They buy, and then they wait for the price to settle back in, or they take some profits off the table. Then they buy, they wait for prices to settle in, and that's what creates that stair step. And so what should happen is when this is done, you should get another impulsive move up. Again, it would help if the market is going to be trending up as well. I can't emphasize that enough. But that it's important you recognize that behavior, and it's not perfect. It could be profit taking, and then there's a reason to sell, and it panic and it drops sharply at that point. But again, those are things we can't control. We can only control. There's a limit to what we can control in a trade, and so what we're just trying to do is recognize the general behavior. Is it acting like it wants to go up? Is it acting like it wants to go down? And then try to align that with our trades as much as possible. All right, I'm gonna go to another couple areas, and then we'll come back. There's a couple more industrial products, but we're running out of time here. So let's go to business services. There was one in here that I liked. This BBSI, and this would definitely be a breakout. Wait for the breakout. But you have kind of this, it pulled back, and now it's starting to move up. You can call this a cup with handle formation. The bottom line is, if it can get above here, then you can take the top of that range to the bottom of that range, project it upward, and you have a pretty decent move that could happen if it can break out. But definitely wait for the breakout. And then if it did break out, then you could go this next. This would be a nice area for a stop. If it broke out, came back down, and went below that, you're probably wrong. Computer and technology. Look at this SMCI. Super microcomputer, 98 strength rank. Same thing here. Nice update today, by the way. Wouldn't be bad to wait for that breakout. You could take the top of the range to the bottom of the range, and you could put it, if it broke out, you could put a stop right in here, right below there. And there's another buyout I want to show you here. This is a really obvious one under computer technology. It's this MAXR. So again, the stock was trading out here, and this is how buyouts work. Somebody came in and said, I want to acquire the company. I'm willing to pay $50 a share. Your stock's at $25 a share. How many people are going to take that that offer? Unless those shares have been in your family for 50 years, or your original owner, you might not be willing to sell. But if you're an average trader, you're like, you got it, double my money in one day. But it's not going anywhere after that. That was the buyout price. It'll stay that way until it's acquired, and usually it dissolves into the new company or whatever. So this ticker symbol will go away, and it'll become part of that new company. And if you want to, you can go do the research on it and find the whole story out. But that's what happened there. And that's how you recognize it if you see this on the scans. All right, let's do just two more on the industrial products. AXON. Where is that? Right here, Axon Enterprise 95 strength rank. Again, very couplet handle formation kind of pattern right here. Wait for the breakout. And then this GWW. Granger, WW Granger. Now this one, again, it's sideways right here, but this probably made it pretty overbought on that move. Here's the breakout area. So the danger of this one is that, you know, stocks will tend to retrace about 50% of their moves. It's probably more likely to have a little bit further to drop, or it's going to stay sideways for a while, consolidate that big move up. So I probably like this one the least of all those ones I just went over on the industrial products. But that, I mean, that's a bullish looking formation. The problem here is that a lot of times when you get this, when you get a big move up and then you get a real sideways move, again, why is it moving sideways for this long after that big move up? That's telling me that buyers are looking for another reason to buy. And the problem with that is that this is where you might break out of that sideways range, but that's where you might get just a breakout, false breakout. It breaks out, unless there's some really compelling reason for it to take off again. It breaks out, and then it goes into that triggers a bigger correction. Because remember, think of this, everyone's waiting to cash in. They're all waiting because of this indecision right here. They're looking for a reason to sell, and if it can break out, it's like, okay, there's my reason. I'm going to just sell right there. I've been waiting and waiting and waiting. I missed this opportunity to sell. It came back down. I missed this opportunity to sell. It came down. I missed this opportunity to sell. It came down. Ooh, there's a great reason to sell. And then it goes into then everyone does the same thing, and it goes into a bigger correction. So there's more danger of that happening right here when you have that big of a move and this long of a sideways pattern. Why is there that hesitancy to buy? That would be my first question there. But it could break out. So if you're looking for just a real quick pop, it could break out and go a little bit higher, and you can try to trade that. All right. I'm going to go ahead and analyze I can take a look at it here real quick. GDX is, yeah, it's right. It's trading at 27.41. My stop's at 27.50. I might end up stopping on that. NEM, 5 cents above my stop. I'll have to make a judgment call on that at the end of the day. A real quick look at the markets. Yeah, they're still positive, but they're not real confirmation with today's move today. It's another indecision day. All right, that's it. Thanks, everyone. Have a good week. We'll see you next Tuesday for the next market update. Bye now.